Welcome to Financial News Daily. I want to start today with a number. 77%. That is the probability, as of this morning, that the Federal Reserve raises interest rates in September. Not a possibility. Not a rumor. A number that 77 out of every 100 traders in the futures market are betting real money on. And yet when the Fed announced its decision yesterday, holding rates steady for the fifth consecutive meeting, most coverage called it a non-event. Another hold. Nothing to see here. I want to spend the next 15 minutes explaining why that reading is exactly backwards. Because what happened yesterday was not a non-event. It was one of the most consequential signals the Federal Reserve has sent in years. And if you have money in a savings account, a mortgage, a bond portfolio, or a gold position, what happened yesterday is going to affect every single one of them over the next 60 days. Let me start with what actually happened in that meeting room. 9 members of the Federal Open Market Committee voted to hold rates steady. 3 voted for an immediate hike. Beth Hammack of the Cleveland Federal, Neil Kashkari of the Minneapolis Federal, Lori Logan of the Dallas Fed. Now, in normal times, a 3-9 descent would be notable but not alarming. But we are not in normal times. We are in a moment where the 30-year Treasury yield just hit 5.2%, the highest level since 2007. Where the US-Iran conflict has entered its 5th month with no resolution. Where Tehran just rejected Oman's proposal for joint management of the Strait of Hormuz, effectively telling the world that the waterway will remain under Iran's control on its own terms. And where the inflation data that the 3 dissenters are looking at, core PCE still running well above the 2% target, is not moving in the direction the majority of the committee has been hoping for. 3 senior Federal Reserve officials looked at that environment and concluded the appropriate policy response is to raise rates immediately. That is not a footnote. That is a statement. Here is why it matters so much. When a Federal Reserve official dissents in favor of a hike, they are not expressing frustration or impatience. They are making a formal, institutional, on-the-record judgment that the current interest rate is insufficient for the current economic conditions. That judgment becomes part of the Fed's historical record. It signals to every market participant on Earth that within the committee that controls the world's most important interest rate, the balance of opinion is shifting toward tighter policy. The 3 dissenters are not fringe voices. Kashkari has been one of the most closely watched members of the committee for years precisely because his views have often been prescient. When he moves to a dissent position, the market pays attention. And the market's response yesterday told you everything about how seriously it is taking this signal. Gold fell after the hold was announced. Not sharply. But it fell. Stocks closed lower. The 30-year bond yield rose further, extending what is already a historic move toward levels not seen in nearly 2 decades. Think about what that market behavior is telling you. The Federal Reserve just held rates steady. That is normally good news for risk assets. Lower rates for longer means cheaper borrowing, higher valuations, more liquidity. The market should have rallied. Instead, it sold off. The reason is that the market is not trading on what the Fed did yesterday. It is trading on what the 3 dissenters tell it the Fed is going to do in September. And what those 3 dissenters tell it is that the committee's internal consensus is closer to a hike than the 9-3 vote suggests. Because here is what most coverage missed entirely. Several of the 9 who voted to hold stated publicly that they would support a hike in September if the data does not improve. This is not the same as believing rates are where they should be. It is a conditional hold now, but be prepared to move. The majority is not united behind the view that the current rate is appropriate. It is united behind the view that waiting 6 more weeks for more data is the right procedural choice. The 3 dissenters disagree with that procedural choice. They think 6 weeks is too long to wait given the data already in hand. That distinction matters enormously. Because it means that even if you look at the 9-3 vote and conclude the committee is mostly dovish, you would be wrong. The committee is mostly cautious. Those are not the same thing. Now let me connect this to something that has been largely ignored in the coverage of this Fed meeting. The 30-year Treasury yield at 5.2% is not just a bond market story. It is a signal about the long-term cost of money throughout the entire economy. And at 5.2%, the 30-year yield is telling you something specific about where the market thinks inflation and interest rates are heading over the next 3 decades. It is telling you that the bond market believes the elevated inflation and elevated interest rate environment we are currently experiencing is not temporary. It is telling you that the people who manage trillions of dollars in long-term capital are pricing in a world where money is expensive for a very long time, not just until the Iran conflict ends, not just until the Fed cuts rates once, but for decades. Howard Marks, the founder of Oaktree Capital and one of the most respected voices in fixed income, has been writing for 2 years about what he calls the sea change in financial markets. The transition from a 40-year period of declining interest rates to a new period of higher for longer rates. Yesterday's Fed meeting and the 30-year yield hitting 5.2% are precisely the data points he has been describing. The sea change he identified is now showing up in the numbers. What does this mean for the assets most people hold? For savings accounts and short-term deposits, the news is straightforwardly positive. If the Fed hikes in September, the yield available on cash goes higher. A savings account that pays 4% today could pay 4.5% by October. That sounds small, but on $200,000 it is an additional $1,000 per year, risk-free, for simply holding cash in the right place. For mortgages, the story is more complicated. The 30-year fixed mortgage rate is already above 7% in most markets. If the Fed hikes and the 30-year Treasury yield stays at 5.2%, mortgage rates could push towards 7.5 or even 8% by year-end. For anyone considering refinancing or purchasing property, the window of current rates, as uncomfortable as they feel, may not be the worst it gets. That is a sobering thought. But it is the one the data supports. For bonds, the picture depends entirely on duration. Short-term bonds, anything under 2 years, are actually attractive right now. You are locking in yields above 4% on instruments that will mature before much of the rate uncertainty resolves. The risk is manageable. Long-duration bonds, anything 10 years or beyond, face continued pressure as long as the 30-year yield is rising. The 30-year at 5.2% today could be 5.5% in 3 months if the data continues running hot. For gold, the situation is the most nuanced. And it is the one I want to spend the most time on, because gold has been doing something in this environment that most people are reading incorrectly. Gold has lost more than 20% since the start of the US-Iran conflict. Most people hear that and think, gold failed as a safe haven. The war got worse and gold went down. What kind of protection is that? But look at the full picture. Over the past 12 months, meaning before the war, during the war, through the rate hike fears, through the 9-month low in July, gold is still up 22.9%. 22.9% in 12 months. That is not a failure. That is one of the strongest performances of any major asset class in the same period. What happened is that gold ran up strongly, from $3,250 to $5,589, before the war even began. The war added a premium on top of an already elevated price. When the rate hike narrative became dominant, that premium unwound. But the underlying price, the price that reflects the structural case rather than the war premium, has held significantly better than most people realize. Ray Dalio, who has been accumulating gold through his Bridgewater fund for years, has a framework for understanding this. He describes gold as the asset that performs best when the two most common investment alternatives, cash and bonds, are both under stress simultaneously. Cash is under stress when inflation erodes its real value. Bonds are under stress when yields rise and prices fall. In an environment where both of those things are happening at the same time, which is precisely the environment we are in right now, gold's role in a portfolio becomes its most important. The 22.9% return over 12 months is gold doing its job in exactly that environment. The question for anyone holding gold today is not whether it failed. It is whether the structural conditions that drove that 12-month performance are still in place. And they are. Central banks have been buying gold for 19 consecutive months. The U.S. debt-to-GDP ratio has crossed 100%. The 30-year Treasury yield is at a 19-year high. The relationship between paper money and real value is less certain than it has been at any point since the 1970s. None of those structural conditions change because the Fed held rates yesterday. They did not change when gold fell to $3,975. They are not going to change when the September meeting arrives. What changes them is a scenario where inflation falls decisively back to 2%, where government debt stabilizes as a percentage of GDP, and where central banks around the world reverse their gold buying programs. None of those things are imminent. The three dissenters at Wednesday's Fed meeting are a signal. The 30-year yield at 5.2% is a signal. The 77% September hike probability is a signal. Each of them is pointing in the same direction. The question is whether you are positioned in a way that acknowledges those signals, or whether your portfolio was built for a world that no longer exists. That is the question worth sitting with this week. Not what happens to gold next Thursday. Not whether the Fed hikes in September. Whether the structure of what you hold reflects the environment that actually exists, or the one that felt most comfortable when you last reviewed your finances. Everything here is for informational purposes only. This is not financial advice. Please consult a qualified financial advisor before making any investment decisions. All information here is purely for your reference, to help you think clearly, not to tell you what to do. One question before you go: do you think the Fed raises rates in September? Comment below. I read every single one. We do this every week. Stay informed. Stay ahead. Financial News Daily.